Hi, friends. How are you? Today, we're going to talk about how to trade in volatile markets. Bitcoin is probably one of the most volatile things you'll own in crypto in general. For today's purposes, I'm going to be talking mainly about Bitcoin when I talk about cryptocurrency, because in general, Bitcoin holds a far bigger percent of the crypto market than anything else. It holds still today, it holds about 40% of the crypto market. And wherever Bitcoin moves, the rest of crypto tends to follow. So for today, we're going to be focusing on Bitcoin. But we're going to be talking about discipline, a little bit about math, a little bit about dollar cost averaging, and your time horizon. So what we're going to do initially is I'm going to share my screen with you, and I'm going to show you some charts. So we're going to start with the 1-year chart of Bitcoin. And I want you to take a look at these three dates. So it hit an all-time high in November of 2021. It fell precipitously. It rose again and hit another mini rise on March 29th of 2022, fell all the way to June. And over the past 4 months, the intraday high has been on August 15th, where it hit 24,000. So August 15th, March 29th, and November. Now I want to look at the S&P 500. This is the 1-year chart of the S&P 500. The S&P 500 is, here's November 9th, very near its all-time high. It didn't peak until December, but by November, it was already very near its all-time high. Also fell in the new year. And on March 29th, late March, again rallied, only to drop again all the way into June. And there's that date again, August 15th. Now we're going to go to a chart of the QQQ. The QQQ is the Invesco NASDAQ 100 ETF that tracks the NASDAQ 100, the biggest 100 companies in the NASDAQ. And again, here's November. It delayed and didn't hit a peak until December, but right around November, December, then it fell. Then there's that late March again, March 29th, followed by a drastic fall, only to go and rise again on the 15th. Then we're going to slip back and we are going to look at the max chart for Bitcoin. Bitcoin, which is one of the most volatile things you can own, no one has ever lost money. Not a single person has ever lost money in Bitcoin if they've held Bitcoin for 4 years. But it's actually, the actual dates are a little bit shorter than that. So let's say that you had just been buying Bitcoin and it was all the way down here at $200-300 back in 2016, 2017. And then it began to climb. And you bought Bitcoin at its height at that time, which was in December of 2017, and you bought it for $19,000. Over the next 2.5 years, you would have looked like an idiot because it went down. Everyone's saying it was a scam. Everyone was saying it was a Ponzi scheme. And it began to climb again, but then it fell again. But just 3 years later, in December of 2020, it was already above 19,000 again. And just later that month, it rose to 23,000. So you were above the all-time previous high. And that's only 3 years later. Let's say that you follow the chart this way and you were unlucky enough to buy Bitcoin again in April 13th of 2021 for $63,000. And then it just crashed all the way again to $29,000. You lost more than 50% of your money by July of 2021. How long did it take you to make that money back? Well, by November of 2021, just 7 months later, it was already back up to 69,000 up here at its all-time high, intraday high, 69,000. As you can see, over the last year, Bitcoin, let's go back to the 1-year chart again, Bitcoin's price has fallen. And the question now is, what is the time horizon to get it back? And if so, not only if you were unlucky enough to buy back here at the high, but specifically what would happen if you were trying to trade in this volatile market right now. So now we're going to stop the screen sharing. We're going to come back here and I'm going to talk about a concept called dollar cost averaging. So that's the first thing about a volatile market. You have to go in slowly. Dollar cost averaging is nothing more than saying, let's say you have $100 to invest. You don't invest that $100 all today. You say, I don't know what the markets are going to do. They're so volatile. I am going to invest in small batches. They're called tranches. So you could say, I'm going to invest in 10% tranches to equal all my $100, $10 over the next, and you pick a time horizon. That time horizon for you could be 6 months. The time horizon for you could be a year. For our purposes, for our company, for you, we're trying to show the value of our company and make you money in 6 months. So let's just pick that as the next, as the time horizon. Okay, so over the next 6 months, you have $100 to invest. How would you do it? I would recommend that if in that time period you divide that 6 months by 5, and then you divide your $100 by 5. So you're going to put in $20 basically every 6 weeks. And you put it in and you just buy it at whatever price Bitcoin happens to be, or whatever assets you're buying. So you give the markets times to rise and fall and rise and fall. And over that 6-month horizon, you'll get in kind of near the average. Now, there's a couple advantages to doing that. The first is that if you put in all your money in one day and then it crashes the next day, you won't lose all your money. But the second is that you have, in this case, 100% divided by 5. So you have 5 shots at the apple, 5 trades of making money, because each trade only needs to make you a little bit of money for the whole thing to work out. So what I would do is I would say, each of those is going to be $20. And for that $20, let's say that you're going to have an entry price, whatever your entry price happens to be that day. Bitcoin's price today is $20,000. You're going to say, I'm going to take a 10% risk on that. So your sell price is going to be 2,000 above the 20,000. That would be at $22,000. So you buy $20 worth of Bitcoin. You buy it at $20. And you say, you put in a limit sell price, and that limit sell price is $20, I'm sorry, at $22,000. So you're going to make that percent of money. So between $20 and $22, you're going to make a little bit of money. Then you're going to do the same thing for all your future trades. Some of those trades will come in well under 20,000. Some of those trades may come in higher, but each of those you treat as individual trades. And within that, you'll decide what you want to do as far as your buying and your selling. I would say 10% is a good percentage to make. And given the volatility of markets and how much they're going to rise and fall, if you're just patient, you will make 10%. So that's number one. So that's dollar cost averaging. So the second really, though, is for your own individual time horizon. Let's say that you don't have that you don't want to, you say, well, I'm in it for the long run. If you're in it for the long run, as you've seen, no one has lost money on Bitcoin if they've been willing to hold it for a little over 3 years. But the latest models show that what's called the median price, the break-even price of Bitcoin, historically, over the entire lifetime of Bitcoin, the historic break-even price is 21,600. So if you get in below, which the price is today is 21,600, and if you hold it for 3 years, the odds of you losing money would probably be very, very low. So those are the things that you want to keep in mind about trading in volatile markets. However, this market in particular has an overarching factor that we're going to need to discuss, and that is inflation. Everything that has happened in the markets this year has happened because of inflation. So what is inflation? Inflation is that if you have $1 worth of something over the course of time, 1 month, or in the federal government's case, they measure it month over month, and they measure it year over year. So has that price fallen or has that price risen? So if inflation is what it is right now, which is around 8.1%, it means that year over year, and that the value of the dollar has fallen, that your 100 cents is now worth 92 cents. It doesn't mean you actually have 92 cents. It just means that if you go out to buy a cup of coffee or whatever you're trying to buy with that $1, it will be 8% more expensive this year than it was last year. Now, that's an oversimplification, because not everything rises and falls at exactly those percentages. Some things, such as energy, has risen much more than 8%. Other things, and food has risen. Lumber has risen much more than 8%. Other things have not risen at all. But on average, it's been about 8%. So over the course of this year, the federal government had no choice but to do what's called raise interest rates. They're tightening. During the pandemic, interest rates were very, very low, and the government was putting out stimulus packages. They cut the interest rate to between 0 and 25 basis points, which is 0.25%. So that's how much it was costing major institutions such as banks and other things to borrow money from the federal government. This meant it was very good for you. It was very good for you in terms of credit cards. It was great in terms of being able to refinance your house, because rates were very, very low. Your mortgage rates were very, very low. And then this year, inflation, the price of doing business, began to increase, and the federal government has raised interest rates precipitously. So it began in March, and it's risen 4 times this year. The total is 3%. But the federal government also did something else, what's called quantitative easing. Quantitative easing is it bought debt, it bought bonds, and now it's letting those bonds slide off its balance sheet. Those account for roughly anywhere between 25 basis points and 50 basis points over the course of the timeline that they are choosing. So really, what the Fed has risen in between the actual rate hikes that they've done and the quantitative easing is somewhere closer to 3.5%. So the real question that everyone is trying to ask in the stock market today is, the federal government cannot keep on doing this, can they? They can't keep on raising rates 75 basis points every month, because that is driving interest rates up. The 30-year mortgage is now over 7%. What does that mean? Over 7%, that's a number. And if you're not in the housing market, it doesn't matter a lot to you. But if you were to buy a 30-year mortgage, and you and your partner had $2,500 to spend on a mortgage, you could get a rate 1 year ago at 3%, and you could afford a house that was $756,000. That's a nice house. What house could you afford today at the interest rates of 7%? That same house at $2,500 mortgage payment, you could only afford a house that was $420,000. Still a nice house, but those are two very different types of houses. So the federal government is waiting for housing prices and prices in general to capitulate, meaning to drop. So the only tool they have in their tool bag is to raise rates, to raise the cost of borrowing money. So those rates have risen, and they will continue to rise. And Chairman Powell said at the last press conference that he held is that he did not foresee a time right now when he was going to stop or pause the interest rate hikes. He was going to say, he said, I am data driven. I am going to wait to see what for prices to actually fall and for inflation to get under control before I pause rates. So that is why in today's trading environment, you have to be aware of the monthly CPI reports, Consumer Price Index reports. The next one is the 13th of this month, and it will determine the course of trading probably for the next month or two. If inflation has fallen, if the CPI has fallen month to month, meaning less than the previous month, then the stock market will say, Chairman Powell was right, the interest rate tightening is working, consumer price index has fallen, and we are going to go into the stock market and we're going to start a rally because inflation is getting under control. Inflation is falling. The CPI, right now, the CPI forecast is anywhere between 8.1 and 8.3. So the numbers that we want to be watching out for are, it's really, really good news for the bulls if the CPI report is in the sevens. If the CPI report is 7.9, 7.8, 7.6, the lower the number, the higher the stock market is going to shoot up. But if the CPI report comes in at 8.3, 8.4, heaven forbid, 8.5, then the stock market is going to plummet to new 52-week lows. So we have to be prepared. How are you prepared? You never put in your money all at once. Right now, we are holding 80% of our portfolios in cash. We are not putting them in the stock market, in the crypto markets. 20% is in, and I've showed you at the prices that we got in at. We got in at Bitcoin when it was at 19,247. We got into Ethereum when it was at, I think, 1,357. Right now, we're hovering right around those prices, but they're going to start to move. So one thing you need to keep an eye on, CPI. The next thing you need to keep an eye on is the price of oil. 2 days ago, OPEC Plus, who is the plus? Well, OPEC used to be the countries in Saudi or surrounding Saudi Arabia in the Middle East. That was OPEC, the oil producing nations. But they added a plus. The plus is not good news for the United States. The plus is Russia. So Russia has joined OPEC Plus several years ago, and Russia is the only form of money right now that they have coming in is from trading, is from selling oil. They need prices to stay very high. Crude oil prices, which were $120, have now fallen to about a month ago. The low that they fell was back in the 80s, but now they're beginning to creep up again. And 2 days ago, OPEC Plus met and they said, we are cutting production. They are cutting production despite the fact that President Biden went to the Middle East and met with OPEC and said, no, 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 don't cut production. Please increase production so that our European partners can stay warm this winter and they don't have to pay through the nose for their oil and their natural gas. But that didn't happen. OPEC has chosen to side with Russia. So if the price of oil begins to creep up, eventually for this winter, our energy bills and the energy bills of people in Europe are going to start to skyrocket again, which means inflation is going to go back up again, which means that the markets are not going to do well. So those macro forces you have to be very aware of. And that's what our job is here. That's included in the daily coordinates. That's what we're, keep you updated on every day. This is what the big factors are that are in the that are affecting the macro economy. So again, CPI, oil prices, and dollar cost averaging. Those are the things that you really want to do to trade as safely as you can in this volatile market. Now, another concept that people always ask, and I'll use some terms here because this is a little bit more advanced, that people are constantly asking me is, can you buy puts and calls on Bitcoin? So let's say that we know Bitcoin is going to fall. can I buy a put? The answer to that question is yes, you can go and buy a put, but I don't want you to go out and buy puts. So a put is a derivative. Put is a derivative that will increase in value if the price of the underlying asset goes down. A call is also a derivative that will only increase in price if the underlying asset goes up. Okay, so you can buy derivatives because the US, our traditional markets are very sophisticated. You can buy derivatives on virtually anything. You can buy derivatives on the S&P 500. You can buy derivatives on the triple Q, which is the charts that I showed you. And if you guess right and the markets go down, the value of your puts will go way, way up. So people who bought puts in November of 2021 for the entire market for this year, if they bought 1 year puts, they are doing very, very well. So can you do that for Bitcoin? Yes, you can. You have to buy them overseas. The markets for them are not very liquid, meaning they are very unstable. The time horizons are very strange because remember, Bitcoin is not it doesn't have an opening and a close. It trades 24/7. So 365. So the timeline horizons for them are very odd and they are incredibly unstable. So it is a way for you to lose even more money very quickly if you guess wrong. They are not regulated by US markets. It is a really bad idea to buy Bitcoin puts. What I would rather have you do is to do your dollar cost averaging. Let's say you have $1,000 to spend. Take your $1,000 and say, I'm going to buy $200 worth of Bitcoin at this price. And guess what? If you guess wrong and Bitcoin goes down, if you guess wrong from the price that we're at today, if you buy it at 20,000 and it goes down to the 52-week low, what's the 52-week low? 17,500. What's the 52-week high? 69,000. If you hold it for long enough, it is going to come back and you're going to make a profit. So simply buy smaller portions of the underlying asset, Bitcoin, Ethereum, Cardano, Avalanche, Solana, whatever we're buying. Buy them in smaller tranches and then hold them. And just do math upon what your exit price is. And when you're determining your exit price, I want you to do this right immediately when you place your trade. So let's say today I am buying $1,000 worth of Bitcoin. Okay. I'll buy $1,000 worth of Bitcoin at $20,000. And right away, I am going to put in my limit sell order. And I'm going to put in my limit sell order at 22,000. And then I am going to forget about it. That is just math. It's 10% of 20,000. And I don't want you to look at that price again. When Bitcoin begins to climb to 21,000, if it begins to get to 21,600, 700, 800, I don't want you then to go in and cancel your sell order because you think it's going to get to 25,000. It's going to get to 30,000. No, it may, and then come back down to 18,000. And then you're like, oh no, I could have gotten out at 22,000 and made my 10%. Stay disciplined. Do your math. Put in limit orders. When you buy, don't buy it what's called market. Don't buy market orders. Whatever the prices that I share our buy prices with you, buy at limit, sell at limit. Stay disciplined. Take emotion out of it. Those are the ways that you're going to survive in a volatile market. And know your macro forces that are affecting the prices. Know your consumer price index. Know the price of oil. Know what inflation is doing on any given time. That's how you're going to do it safely. Thank you so much. Does anybody have any questions? I'm not sure how many people were able to join, but does anybody have any questions? If no one has any questions, I am then going to, I'll stop it for now. And if you have questions, again, you can ask on our website and we will answer them, to everyone as soon, within 24 hours. Other than that, I will see you all next Tuesday for the next series of the beginner seminars. Take good care. Have a lovely weekend and enjoy the lovely weather. If you're in the Triangle and wherever you are in the world, I hope the weather's treating you well as well. Take good care. Bye-bye.